In fact, India's external debt to GDP ratio is the lowest among the emerging market economies. In fact, yeah, that's right. In the final analysis, we remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures, and I'll be very brief. There are just about 4 or 5 announcements. The first is that we will release a discussion paper on expected loss based approach for loan loss provisioning by banks. Banks currently follow the incurred loss approach for provisioning of their loan assets, whereby provisions on loan assets are made after the stress has actually materialized. A more prudent and forward-looking approach is the expected loss-based approach, which requires banks to make provisions based on an assessment of the probable losses. As a step towards converging with globally accepted prudential norms, we will issue a discussion paper on the proposed transition for stakeholder comments. The second one relates to discussion paper on securitization of stressed asset framework. The revised framework for securitization of standard assets was issued by the Reserve Bank in September 2021. It has now been decided to introduce a framework for securitization of stressed assets. This will provide an alternative mechanism for securitization of NPAs in addition to the existing ARC route. A discussion paper on this proposed framework is also being issued for feedback from stakeholders. The third announcement relates to internet banking facility for customers of regional rural banks. Regional rural banks, that is RRBs, are currently allowed to provide internet banking facility to their customers, subject to fulfillment of certain criteria. Keeping in view the need to promote the spread of digital banking in rural areas, these criteria are being rationalized. The revised guidelines will be issued separately. And the final announcement relates to regulation of offline payment aggregators. Online payment aggregators have been brought under the purview of the Reserve Bank guidelines since March 2020. It has now been proposed to extend these regulations to offline payment aggregators who handle proximity or face-to-face transactions. This measure is expected to bring in regulatory synergy and convergence on data standards. Let me now conclude. Daunting challenges confront us at this juncture. The underlying fundamentals of our economy and the buffers built over the years have stood us in good stead. We have taken a series of measures since April 2022, that is in the aftermath of the commencement of the conflict in Ukraine and the kind of spillovers and the global impact it produced. We have taken a series of measures thereafter since April 22 in the backdrop of, as I said, geopolitical tensions, sanctions and supply chain disruptions. We will remain resolute and persevere in our efforts to ensure price stability as well as financial stability while supporting growth. Our policy actions today is a part of our continued efforts in pursuit of these goals. As we celebrate Mahatma Gandhi's birth anniversary in another 2 days, I conclude my statement with Mahatma Gandhi's insightful words, and I quote, "We are wakeful, ever vigilant, ever striving," unquote. Today, despite the gathering clouds over the global economy, the Indian economy inspires optimism and confidence. Thank you. Namaskar. We now conclude. A stable exchange rate is a beacon of financial and overall macroeconomic stability and market confidence. In recent days, there have been divergent views on the exchange rate of the rupee and the adequacy of our forex reserves. Let me set out the overall position once again. First, the rupee is a freely floating currency and its exchange rate is market determined. Second, the Reserve Bank does not have any fixed exchange rate in mind. The Reserve Bank intervenes in the market to curb excess volatility and anchor expectations. The overarching focus is on maintaining macroeconomic stability and market confidence. Our actions have helped in encouraging investor confidence as reflected in the return of capital flows since July. Over the medium term, the primacy of price stability embedded in our flexible inflation targeting framework provides the anchor for exchange rate stability. These are the 2 points which I mentioned. I would now like to mention the third point. Third, our interventions in the forex market are based on continuous assessment of the prevailing and evolving situation from the point of view of the approach which I just explained. The aspect of adequacy of forex reserves is always kept in mind. The umbrella, as I had said earlier, continues to remain strong. During the pandemic, forward guidance gained prominence in Reserve Bank's communication strategy. This was helpful in anchoring market expectations. In a policy tightening cycle, however, it is arduous to provide consistent forward guidance, particularly in a highly uncertain environment. In fact, forward guidance may even destabilize financial markets. Questions are often asked about the peak and terminal rates in a rate hiking cycle or in a rate tightening cycle. Without venturing into any forward guidance which can be hazardous in the present context, I would like to state that our actions will be carefully calibrated to the incoming data and the evolving scenario without being constrained by conventional or any textbook approach to policy making. Let me now focus on the external sector. The current account deficit for the first quarter 2022-23, and that was released last evening, is placed at 2.8% of GDP with trade deficit at 8.1% of GDP. Various leading indicators including global PMIs point to weakening of global growth momentum and downside risks to global trade. India's import growth, though decelerating, outpaced the export growth. Consequently, the trade deficit remained high in July and August. Services exports continued to grow at a robust pace amidst resilient demand for software and business services and modest recovery in travel services. On a balance of payment basis, that is on a BOP basis for which data were released yesterday, exports of services grew at a robust pace of 35.4% year on year during April-June this year. For the same period, remittances rose by 22.6%. The net surplus on exports of services is expected to partly offset the higher trade deficit. So as you can see,